when you draw these out, put as much detail in there as possible. I'll try not to go too fast. So the first question is using the Fisher equation, which is right here. That's I to the n equals the real rate plus inflation expectations. Okay, so you need to, at some point you're going to need to write that out. What I would do first, this is good. What variables drive risk-free rates, nominal interest rates, U.S. Treasury securities by maturity up and down and shifts the yield curve up and down, flattens and inverts it. That's it. Show the equation and graphical representation for a normal, upward sloping, flat and inverted curve. And what are the three yield curve theories? And what impact do movements and shifts in the yield curve have on asset prices? First thing first. So what I would do when drawing out the yield curve is I would go like this. And then like this. Okay. And the next thing that I would do is do this one right here, like this. So this is your upward sloping yield curve. And then on the x-axis, you want to write maturity. And on the y-axis, you want to write nominal interest rates, IN, YTM, which is your yield to maturity. So basically the interest on these bonds. Interest is also called the yield to maturity. Okay? So IN, YTM, yield to maturity, maturity of the bond. So basically what you have is interest rates here on the y-axis, and you have maturity on the x-axis. Next thing you're going to want to write down is 3-month, 6-month, 9-month, 1 year. 3-year, 5-year, 7-year, 10-year, 20-year, and 30-year. And then you want to connect the maturities with the interest rates. I3, I6, I9, I1, I3, I5, 10, 20, 30. So basically for each maturity, there is a given interest rate. Okay? And the yield curve is upward sloping. Okay, and I'll explain that now. So the first thing you want to do is set up your yield curve. It's all attention to detail, right? So there is a corresponding interest rate for each maturity of the bond. Put a little box around the 10-year treasury yield. Put a little box right here around the 10-year, because that's the base rate to price all student loans, car loans, mortgages. So the 10-year treasury yield is the reference rate to price all of those loans. Okay? And then draw a little line between the 9-month and the 1 year. And tell me if I'm going too fast.
I have a question.
Yeah.
What are the numbers on the y-axis again?
These here?
Yeah, like what?
Yeah, so this is, for example, this is the 3-month treasury bill.
Yeah.
And this is the 3-month treasury bill interest rate.
And what is that interest rate that I'm writing? Is there a number there?
Yeah, it's I3.
Oh, I3. Okay.
Yeah, these are I, and it's I3, I6,
Oh, okay.
I9, I1. So for each maturity, there is a given interest rate.
Okay. Thank you.
And this is an upward slope, or a normal curve. Okay, this is a normal, and it's upward sloping like this. It's called normal or upward sloping. Yes.
What did you say the x-axis was?
This is the maturity on the bond.
3 months. Maturity on the bond.
Yeah, so the bond has a life of 3 months, 6 months, 9 months, 1 year, 3 year. So at the end of when the bond's going to pay a coupon interest payment to you either annually or biannually, and then at the end of the maturity, you're gonna get your principal back, which is the $1,000. Okay.
You said the numbers were 5, 3, and then what?
Yeah, so 3, 6, 9, 1 year, 3 year, 5 year, 7 year, 10 year, 20 year, 30. Okay. So the first thing you do is you do the upward slope, you set up your maturities, you set up your interest rates, and then you tie them all together. Okay. Tell me when you guys are ready. And make sure you write in, right above this, upward slope and normal. Okay, upward slope and normal. Okay, upward slope and normal. This is a normally an upward sloping yield curve, and it's a normal yield curve.
What does it say next to the I?
Right here.
I remaining, or no, right under yield to maturity.
Right here.
Yeah.
Nominal.
Oh no.
Yeah, it's the nominal interest rate. The curve is also called the risk-free. These interest rates are also called risk-free rates because they're U.S. government bonds. These are U.S. government treasury securities. They're considered risk-free. Okay? Because there's no way the government can default on the bonds. Although Russia, Italy, and Greece have all defaulted on their bonds. But the assumption is the United States will never default on their bonds because they could always raise taxes to pay off the coupon interest rates and the premiums that come due at the end of maturities. Or they can print money to service the debt. So they're considered default-free or risk-free. Okay. Does everybody have that? Okay. Then you want to write here the 3-month to 9-month. Underneath it, write money market. Okay. Write money market. And then 1-year bonds that have maturities of 1 year or greater are considered the capital market. So corporations and governments raise money in both the money market and the capital market. Stocks are also considered capital market instruments because they're long-term. There's no maturity in most, they're very long-term investments. Okay. Then, and here's your, you want to write your Fisher equation up here. Okay. So IN, which is the nominal interest rate, equals the real rate plus inflation expectations. Okay. Now, the first thing you want to do is to shift the yield curve upwards. Can I use my red? So let's say that inflation expectations go up. That drives interest rates up across the yield curve. And if interest rates, if inflation expectations go up, then nominal interest rates go up, and the yield curve shifts up. So you want to shift. You also want to put in the arrows, showing that the yield curve shifts up. So everybody in the marketplace is anticipating higher economic growth and higher inflation expectations, which shifts up the yield curve. Okay. And I'll show you the impact of that on prices in a second. And then if the market thinks that inflation expectations, due to slowing economic growth or contraction in the economy, the yield curve is going to shift down. You need to write this down. This is the major thesis right now. Is that all debt, you need to write this down, all debt, all equity securities are priced off of the yield curve. All debt, all equity securities are priced off the yield curve. And that basically states that if a company or a government, say a company, wants to issue bonds, first thing they're gonna do is go to the yield curve to price it. So if the company's gonna issue a 10-year bond, then they're gonna go to the 10-year treasury yield, and that's gonna be their base rate. That's the rate that they're gonna start to price the security, then they're gonna start adding on credit default, risk premiums and liquidity premiums, maturity premiums, to get to the yield of maturity for that bond. So any movement in the yield curve is gonna have an impact on corporate bond prices. Yes.
Just to clarify, when does it shift up?
The yield curve shifts up when inflation expectations across the curve, across all the maturities, go up. The yield curve is going to shift down across all the maturities when inflation expectations fall.
Okay.
So when inflation expectations go up, nominal interest rates go up. When inflation expectations go down, nominal interest rates go down. This assumes that inflation expectations are uniform across the whole curve and across all the maturities. It's going to cause it to shift up and shift down. Any other questions? Yes, sir.
You said all debt and,
Equity.
yeah, all debt and equity
Equity
securities?
securities.
Okay.
So if I'm going to issue a stock, first thing I'm going to probably do is go to the 10-year treasury yield. Okay. And I'm going to price my cost of equity, either the expected return on the equity or the cost of the equity. And when we price a stock before we issue it, we are going to come up with the expected return by the marketplace, which is going to determine our cost for issuing those stocks. We're going to use the capital asset pricing model. So if the 10-year treasury yield goes up, then the risk-free rate is going to go up, and the cost of our equity is going to go down, which means we're going to get lower prices for our securities. Or if the 10-year treasury yield goes up really high, stock prices are probably going to go down. If the risk-free rate goes down, then the cost of the equity goes down, stock prices go up, and I can issue my shares at a higher price. So the cost of the equity and the expected return by the investors in the stock, you have to start with the risk-free rate. So any movement in the risk-free rate is going to have an impact on your stock prices. Okay, any other questions? Okay, so let's talk about what the effect of shifts in the yield curve will have on bond prices. Okay. So here's the value of the bond equation right here. So the value of the bond is your coupon payments that you're going to get in the future based on the maturity of the bond. So let's say this is a 5-year bond, and the coupon pays annually. Okay? And the principal amount of the bond is $1,000. And the bond is yielding, or the bond coupon interest is 10%. So we're going to get $100 annually. It's the 10% times the 1,000. We will receive over the 5 years $100 a year, or $50 if it pays semi annually. But at the end of the 5 years, I'm going to get my principal amount back of the $1,000. So this principal amount does not grow. The coupon payment does not grow. So basically, me as a bondholder, in buying the bond, I'm going to get the coupon payments and I'm going to get the principal back at the end. The problem for me as a bondholder is I'm scared that inflation will be high in the future because my coupon and my principal are fixed. So that if inflation goes up, the purchasing power of my coupon payments and the purchasing power of my principal in the future is going to be lower. So the bondholder wants to be compensated for future inflation. That's why the interest rates on these bonds, the yield to maturity on these bonds, include some type of inflation component to compensate me for the deterioration in purchasing power due to the structure of the bond. So if the yield curve shifts up and interest rates shift up, then bond prices are going to go down. And if the yield curve and interest rates shift down, then bond prices are going to go up. Okay? All right. What else did we say here? Show the equation graphical representation of a normal upward sloping. Now we have to show the flat inverted curves in the three theories. So this is the way I set it up right here. So I have three charts. One for a normal curve, one for a flat curve, and one for an inverted curve. And you need to put the equations in here. You need to show me that when the yield curve is upward sloping, inflation expectations are positive. When the yield curve is flat, the inflation expectations are 0. And when the yield curve is inverted, I forgot to put that again. I n equals 3 plus e over negative. Like that. When the yield curve is inverted, inflation expectations are negative. The other point is in a zero inflation or zero inflation expectations environment, under no inflation or inflation expectations, in that environment, the nominal interest rate is the real rate. So it basically states that when the yield curve is flat and inflation expectations are 0, I'm going to require a real rate of return, which is going to be the minimum rate of return that I require in a zero interest rate environment. There are 4 theories for yield curves. There's the inflation, the expectations hypothesis, preferred habitat theory, the market segmentation theory, and liquidity preference theory. And these 3 theories are related to each other. They're a little bit nuanced, they're a little different, but they're basically related to each other. So the inflation expectations hypothesis is the Fisher equation that basically states that movements in the yield curve, shifts in the yield curve, or movements in the yield curve, as it flattens or inverts and goes back down, is driven mainly by inflation expectations. So the expectations hypothesis is the Fisher equation that states that movements in the yield curve, shifts in the yield curve, are driven by changes in inflation expectations. Okay? Now the preferred habitat theory, market segmentation, and liquidity preference theory basically state that the bond market is segmented. And marketing people should understand this because you have market segmentation. You have stratification within your markets. And it basically says that the market is segmented or stratified between short-term maturity bonds, medium maturity bonds, and long-term maturity bonds. So the market is segmented. There's different supply-demand characteristics for short-term maturities, medium-term maturities, and long-term maturities. And I'll give you an example of that. Most corporations most governments want to borrow on the short end of the yield curve. It's called the short end of the yield curve. You want to write that in. Short end of the yield curve. And then there's the long end of the yield curve. So businesses and governments want to borrow on the short end of the yield curve because interest rates are lower. So it's cheaper to borrow on the short end of the yield curve than the long end of the yield curve. However, some corporations have gotten themselves in trouble by doing maturity mismatch. Okay? They're basically using short-term liabilities because they're cheaper to buy long-term assets. Okay? Or they're using long-term liabilities to buy short-term assets. So you have a mismatch. You want a maturity, or what is called duration matching. So good, prudent corporations will use short-term liabilities to finance short-term assets. Medium-term liabilities to finance medium-term assets. And long-term liabilities to finance long-term assets. So the markets are segmented. So governments and businesses prefer to borrow and lend on the short end of the yield curve.
Is the 1 year part of the short end, or is it?
Yeah, that's part of the capital markets. It's relatively short, but I would say, 9 months and under.
Okay.
Okay. This is where the Federal Reserve conducts monetary policy. We'll get in there in a minute. And then you have companies that are raising capital, let's say 5-year bonds to finance 5-year equipment. And then using 10-year bonds to finance 10-year economic life assets. Now, so businesses use the medium term to finance equipment. Okay, that can be depreciated very quickly. The long end, corporations don't like to be out there because the cost of capital is a lot higher. But pension funds and endowments want to buy 20, 30-year bonds because they've done the actuarial projections and the majority of their pensioners are going to retire in 20, 30 years from now. So they need to have bonds that are going to come due in 20, 30, 40 years to be able to pay out the pension liabilities to the pensioners. So that's the preferred habitat where businesses and governments prefer to be on the short end. Pensions and endowments and large institutional investors want to be on the long end of the curve. The market's segmented based on maturity, short-term, medium-term, long-term, and then also the liquidity preference. So I'm an investor. I don't need the money for 3 months, so I'm going to buy a 3-month bond, and the money's going to come due in 3 months when I need the money. Or I'm a pension fund that needs the liquidity in 20, 30 years from now. I'm going to buy 20, 30-year bonds that are going to come due in 20, 30 years from now so that the money's available for me to pay out the pension liabilities to my pensioners. So that's the liquidity preference. And what impact do movements and shifts in the yield curve have on asset prices? Well, we know if the interest rates go up, prices go down. Interest rates go down, prices go up. Okay, we got that. Show the equation and graphical representation for a normal curve, got it. Flat, inverted, and upward sloping. Here's another thing that I did, is I put the flat curve right here. I did a flat curve right here. And then put in the arrows so I could see how a flattened yield curve would look like. And then I put in the inverted curve right here with the arrows to show what it would look like if the yield curve inverted. And the yield curve goes like this. It can shift up, it can shift down, it can flatten, invert, and go back down. It doesn't do this much, right? And it doesn't do this. because the Fed is moving in and basically controlling the short end of the yield curve, so it kind of flaps around like that. How does the Federal Reserve influence interest rates? Well, the Fed influences interest rates through open market operations. That's the monetary policy tool for the Fed. So the Federal Reserve uses open market operations as the monetary policy tool to buy and sell bonds in the open market through the Federal Reserve Bank of New York to drive bond prices up, interest rates down, to stimulate the economy. To sell bonds, to drive bond prices down, interest rates up, to cool the economy. So this monetary policy tool is the main tool that the Federal Reserve uses to manage the business cycle. Okay. What policy tool do they use to move interest rates? Open market operations. What is the objective of buying and selling bonds? If the Fed buys bonds, then bond prices go up and interest rates go down. And the Fed stimulates the economy. The Fed sells bonds, bond prices go down, interest rates go up, and that cools the economy. Okay. What is the impact on interest rates or yield to maturities? Okay, we already talked about that. Does the Fed control and influence directly short-term or long-term interest rates or both? You need to write this down. The Fed influences short-term interest rates directly. The Fed influences long-term interest rates indirectly. For example, when the Fed starts selling off the bonds, driving down bond prices and driving up interest rates. Once the curve inverts, people anticipate a recession, and it starts to lower long-term interest rates. So that's an indirect effect. So the Fed will conduct monetary policy on the short end. They drive up interest rates on the short end, it inverts the curve. People are going to anticipate a recession, and the medium and long-term interest rates are going to fall. If the Federal Reserve buys bonds, drives up bond prices, drives down interest rates, and causes the curve to go normal again, the market's going to think that they're going to stimulate or overstimulate the economy, and it's going to raise inflation expectations and push long-term interest rates up. Okay. Yes, did you have a question?
Yes. So sell bonds, the bond price goes down.
And the interest rates go up. Got it. When they buy the bonds, bond prices go up and interest rates go down. That's why the yield curve is so important, not only from a cost of capital standpoint, but it basically tells you what the Federal Reserve is doing and what the market thinks about future economic activity and inflation. That's why I focus so much time on it, because it's the underlying foundation for finance and economics. Okay, any questions on that? Okay, all right. So the next one is D, capital and commodity markets. So this is basically it's what we do every single class, right? We're being trained to follow the markets. We're also being trained to be able to identify the factors that are influencing the markets. We have to understand where the markets are, where they're trending, if they're up or down, and what are the factors that are causing it. So this is what we did last class. So what I do is I set up a class like this. Asset class here, stocks, oil, gold, bonds, US dollar, and FX, which is foreign currency. Okay. Here, I have the levels. Oh yeah, thank you. I appreciate it. I forgot to ask somebody to mute my camera first. Thank you, I appreciate it. So I set up the box, I have asset class, level, up or down, by how much, what the change is, and then comments. Basically, and this actually flows right into your, the next two sections on the exam, flows right into your memos. Okay, so I'm training you to be able to forecast. Not only identify the factors that move the prices in the market, but what are the factors that are, causing the prices and the values to go up and down. So the last class did the research for you, so I'll slow down and walk you through what we went through last class. So the Dow Jones Industrial Average as of an hour ago or less was trading at 25,957. Okay, over the last couple of weeks, the stock index has been trending downwards. It's down today by 745 points, okay, almost another 1.5%, okay, which it basically takes back the 5% that was up yesterday, which was one of the biggest moves in the stock market in an upward direction ever. So we're seeing all-time, historical drops in the stock market, and we're seeing historical rises in the stock market, although it came off almost another 1,000 points today. Okay? Even with the Federal Reserve cutting interest rates by 50 basis points this morning, which had no effect on the market. Maybe the market would have been down 1,000 points today if the Fed hadn't cut interest rates this morning. Or maybe the markets would have been down 1,500 or 2,000 points if the Fed hadn't cut interest rates. And if the stock market falls too fast, too far, the New York Stock Exchange will implement a circuit breaker and will shut down the exchange because they're trying to quell panic selling or a stock market crash. Okay, so what is the reasons why stock prices have been falling? We said coronavirus and basically falling or contracting gross domestic product on a global basis, but particularly out of China and Korea and Singapore and Japan, which are all major export-oriented economies. We don't even know what's going on yet in Vietnam and Malaysia and Indonesia. We don't know yet. Oil prices are now trading at 47.07. The trend has been downwards. And the last class calculated over the last week that oil prices have dropped $6.30, which is a huge drop. Due to rising global supply, due to falling global GDP, or aggregate demand. There could be other factors here, but these are just some of the stuff that we came up with right off the top of our head. For gold, gold is up to 1641 or 1642, trending upwards. It's up $1.90 over the last couple of days. Due to fear recession, geopolitical risk also, because as economies fall into recessions, their political systems also start to come under stress. So I would throw in geopolitical. I should get a global perspectives credit for this class, don't you think? And then liquidity. People are going into gold because they know that it stores value and it's highly liquid. So if they're scared, they're looking for liquidity, they're looking for safety, they're looking for a hedge against devaluation in currencies. Because as your economy starts to contract, the value of your currencies start to depreciate. The bonds, what did you say it was? 0.97. Yeah, 0.97. Is that correct? Can you confirm that for me? Because that's scary. Okay. We've never been here before. Okay. We've never been here before. Ever. Yep.
0.956.
Jesus. So 0.96. Got it. So if interest rates are falling, what does that tell you about inflation expectations? yields are falling and the real rate is constant, what's driving the interest rates down? Inflation expectations. Do inflation expectations go down in a recovery of growth in the economy? Are prices bid up when the economy is contracting? Prices drop. Got it. So interest rates are falling because inflation expectations are falling because the market is anticipating a recession. Okay? Got it. So interest rates are falling, bond prices are going up. Interest rates are falling, prices are going up. Okay? The 10-year treasury has dropped over 50 basis points in a week. Okay? That's a huge one. Okay? That's a huge one. Why? Fear of recession, liquidity needs. Fed cut interest rates this morning by 50 basis points. So accommodated monetary policy and interest rate cuts. The dollar to the pound and the dollar to the euro. The dollar to the pound. The dollar's appreciated. The dollar to the euro. The dollar's depreciated. Over the, if you go back and look over the last 2 to 3 weeks of the last month, the dollar's actually appreciated against foreign currency. Why has the dollar appreciated against foreign currency? Because the anticipation is that global stock markets will careen as they fall into a deep recession. People are getting out of foreign currency and foreign markets and converting from foreign currency into the US dollar as a safe haven. The dollar is the global medium of exchange. All international transactions are transacted in US dollars. It's the reserve currency. We have relatively stable politics, relatively low inflation. We have a huge economy, huge population base. We have basically a system based on private property rights and enforcement and rule of law as of today. And those are all factors that are creating major capital inflows into the US dollar, right, and causing the dollar to appreciate. Recession fears and liquidity needs. Since the US dollar is a reserve currency, people want to be in US dollars so that they can move their money around when it's safe again to enter the global markets again. Okay? So that's what I was trying to do there. And trying to, again, get you to engage in the current capital markets. And these 5 asset classes, why are we tracking these 5 asset classes? What's unique about these? Because all of your wealth is going to be tied to these 5 asset classes. Okay? Your grandparents' wealth, your wealth, that you're going to be saving and investing when you're working, you're going to be investing in stocks, bonds, gold, oil companies, exchange traded funds, mutual funds. You're going to be conducting your transactions in US dollars. There are trillions and trillions and trillions and trillions of dollars in these 5 asset classes owned by individuals and large institutions. There are trillions and trillions and trillions and trillions of dollars transacted in these 5 asset classes every second of the day, every day of the week, 24 hours a day. Okay. So if you believe in capitalism, which I assume you do, you're going to be exposed to these asset classes over the long run for you to be able to accumulate wealth. Okay. All right. Any questions? That answers the first part of that question. Any questions? So let's do the next one. How much time do I have? Okay. So let's go to the next one. Dynamic asset class supply demand analysis. This one is to train you for your memos. Okay? Because the memos ask you, are the prices going up or down by how much over what period of time based on the following factors. So what we're gonna do is I'm gonna train you and walk you through the dynamic asset class supply demand analysis. So that when you're reading the articles, when you're reading the research behind the asset classes, and you're forecasting, the prices are gonna go up or down over some period of time, you're gonna see these factors mentioned in these articles. And different factors affect the prices differently at different times. Okay. So the first thing that I would do is set up the supply demand graphs. I would do supply first here. Then do supply. Put in your supply curve. I hope you know that's the supply curve. Then you're going to put in your demand curve. Then what I would do is put in the E right there because that's your equilibrium point. Right here is going to be Q star for supply. Okay. This one over here is going to be P star. So that's the price when supply and demand are in equilibrium. And then what I would do is I would come down and I would set up the demand side, basically the same graph. You got your supply, you got your demand. And then what I like to do is this is the quantity demanded, star, equilibrium, and my price star. And then what I do is I connect the two. So that's how I start. And then what we'll do is we will shock the systems. Okay? We will shock the supply curve so it shifts back. We will shock the supply curve so it shifts out. We will shock the demand curve, it shifts it up. We will shock the demand curve, it shifts it down. So I'll walk you through that stuff. So let's first, what we're going to do is we're going to do stocks. We're going to do the microeconomics of the stock market. What's so funny is I get done with this lecture and I look at my shirt and it's all in multicolors and stuff like that. All right, so let's shock the supply curve for stocks. So the first thing you want to do, like this, S1, show me the arrows. And what's going to happen is the supply, here, this is you're going to get Q1, S, and the supply curve is going to shift back. And prices are going to shift up. And you're going to end at P1 up. The supply shifts back and causes the price. So the question is, what would cause the supply curve to shift back for stocks? Well, over the last 10 years, corporations have issued all these bonds at really low interest rates, taking that cheap money and did stock buybacks and bought back their stock to not only inflate their stock prices through financial engineering and an accounting gimmick, but also to push their stock prices up so high that the senior level managers that had stock options in the company now have their stock options in the money so they can exercise their options. So it was a way to manipulate the stock price to get it to go up. Usually stock prices would go up due to higher revenues and earnings and those things, but this is just an accounting thing. Okay. That's what they did. You can get you can also reduce the supply of stocks through what is called a reverse stock split. When companies do a stock split, they'll give you 2 to 1, 2 for 1. So I got 1 share, they give me 2. Woohoo, awesome. But in a reverse stock split, they're going to take 2 of my shares and give me 1. Now, why would companies do that? Well, the reason why they would do that is because their stock prices drop so fast and so far that they're trying to keep the stock price above the $10 mark. Because if they fall below $10, institutional investors will have to liquidate their positions, and that would cause the stock price to drop anyway. Most companies that do reverse stock splits, it's basically writing on the wall for them. They're not going to be around in the future because they couldn't grow the revenues to get the stock price to go up. They had to do a reverse stock split, which is a given. What would cause the supply curve to shift out? Okay. That would cause the quantity supplied to shift out and cause the prices to fall. So what would cause stock prices, the supply curve to shift out? You could actually, I didn't even put this on there, you could do stock splits. But not a lot of companies do them, so it's not a big deal. These are the 2 that would cause the supply curve to shift out significantly. Is that companies 2 weeks ago, 3 weeks ago, when stock prices were at their all-time high ever, they started to do initial public offerings. They were going public for the first time. So a lot of companies were going public. And a lot of companies that already had shares that were trading in the market did secondary or seasoned offerings. So you get a flood of these shares. The worst case scenario is everybody's going public, right, at the same time that the market's correcting. That's the worst scenario. So those are the only things that I can think of that cause the supply curve to shift back and out. So those are factors that you may hear about. What would cause let's do the demand side now. Okay. So what would cause the demand curve to shift up? Cause the quantity demanded to shift out and cause the prices to go up. So I came up with a list of a bunch of factors that could do that. One were higher earnings expectations, higher profit expectations for the company to create higher demand. Higher production for gross domestic product due to higher aggregate demand. Higher employment, low unemployment. Low unemployment, high unemployment, you get wage growth, you get higher wages. If people are making more money, they're going to consume more, it's going to be good for stocks. They're going to save more and they're going to invest more, which is all good for stocks, because that savings is going to go into the stock market. Higher population growth, I could even put in-migration in there too. It used to be that 1% of our population growth was coming from immigration. So just long-term population growth would create demand for, higher demand for stocks. And lower interest rates. So as interest rates go down, expected returns and costs of capital go down, it makes it cheap for companies to borrow and invest and become more profitable in light of higher demand. And also when interest rates go down, companies' weighted average cost of capital goes down. Okay. Which makes it more likely that they're going to borrow and invest in new plant equipment and new projects, and advertising campaigns, and other corporate investments. So what I do is once I get this set up, I can just flip it for the negative demand shock. Okay? So what would cause the demand curve for stocks to shift down? Okay, shift down. Got it. Would cause the quantity demanded to shift back and stock prices to fall. You just reverse the logic in most cases. So you're going to get lower earnings expectations, lower profit, lower production, gross domestic product, aggregate demand. You're going to get lower employment, falling wages. You're going to get lower population growth because people don't have kids, but economies are contracting, going into recession. And higher interest rates, higher expected returns in the market, higher cost of capital, less investment, less capital accumulation, are all factors that would cause the demand curve to shift down. How are we doing on time?
24 minutes.
Okay, I think I can do one. Let's do oil. Okay. Let's do oil. So once I set up the microeconomics, Marshallian theory, I can go through the logic. This is what goes through traders' heads. CEOs, CFOs, CIOs, they have basically supply-demand curves in their brain, right? Just like the Fisher equation, weighted average cost of capital, and CAPM, and adoption curves, and S curves. I mean, which I'll go through all that. So they have all that stuff going in their head, and that's what they use. Because the business practices that you're learning, all the logic that you're learning, is best practices. That's why you're learning, based on years and years and years of basically vetting the theories. So it's all best practice. Everybody has this stuff in their head. So let's do that. So what would cause the supply curve to shift back for oil? And you guys have probably started researching some of this stuff. What would cause the supply curve to shift back for oil? Who's the major market maker in oil on a global basis? Who controls the oil market on a global basis? Exactly, and that is called what? It's Saudi and a bunch of other countries called a OPEC, which is a cartel. Got it. So if OPEC decides to do what? To do what?
Like not sell their oil?
Or cut back on oil production, is it going to have an impact on the oil prices? So you got OPEC. So if OPEC cuts back, the supply curve shifts back, the quantity supplied shifts back, and the prices are pumped up. Now, unfortunately, global economic demand for oil in the macro market, OPEC is not going to be able to cut back on oil production to try to prop up oil prices in the face of a declining Chinese economy. So it works to a certain degree, but not all the time. So production cuts. Can you think of anything else that would cause the supply curve to shift back? Let's just use that one for now. Now, what would cause the supply curve to shift out, quantity of supply to shift out, and prices to fall?
Overproduction.
Yeah, overproduction. What's the major contributor to global oil supply currently, and it's been growing over the last 10 years? In the United States, to the point where the United States 3 years ago became a major exporter of oil for the first time in history. Huh? No. What has created more production of oil?
Fracking.
What?
Fracking.
Got it, fracking. So if you're getting more oil production through fracking, is it gonna shift out the supply curve? Yep. I mean, supply is gonna shift out prices. There could be some other factors too, but let's go to the demand side. What would cause demand for oil to shift up? Quantity demanded to shift out and prices to go up? I'll take it. Anything else? There could be some factors in some models that could also be factors in the other. There could be factors in one market that could be applied to the other. Can you tell me? I laid it out for you. So can you just tell me?
Higher production, higher earnings expectations.
How about higher production, yeah? So GDP. Normal. So if there's higher production, are you gonna demand more oil? Absolutely. Okay. What else? Higher population, I don't think there's an effect on interest rates. Let's use those for now. Let's do the opposite. And you may come up with some others as you do your research. What would cause the demand curve to fall for oil, causing quantity demanded to fall and prices to fall?
Production, GDP.
Falling. Falling population. Give me another reason that would cause demand for oil to go down. You guys know this one.
Alternative energy
Yeah,
sources.
exactly. Is that what you're gonna say?
Oh,
Something
I'm
like
just
that?
thinking like right now, people aren't flying as much, but,
Oh, that's a good one.
yeah.
Falling travel overall. And then let's do the higher. Higher alternative energy consumption, renewable. I don't need a lot of factors, but maybe when you do your research, you'll find some other ones that are missing. Yes, sir.
Can overproduction also make demand go down?
Overproduction,
Yeah.
make demand go down.
Or maybe production size.
I'm trying to isolate the supply shocks and the demand shocks. Maybe this is a substitution effect, right? You're substituting carbon and, you know, fossil-based fuels for clean energy. So this is the substitution effect. There could be feedback loops, but, you know, I would try to stick with the main, you know, macroeconomic factors, you know, that are gonna have an impact on supply and demand and the impact on prices. Anybody else have any?
Would lower employment and wages also affect price of oil negatively?
Yes.
Because people would just be buying and able to buy less.
You don't have the money, you're not driving. Also, our So everything that we own, you know, these wool blends and these computers and, you know, our shoes and everything, they're all petroleum-based products. So again, if production's falling, then you're not gonna buy as much clothes, okay, or computers, or the major inputs into the production process are petroleum-based products based on petroleum products based on oil. Okay, anything else? No? Okay. I think I'm gonna leave it there. Okay. Are we all clear? Excellent.
Professor,
Yes,
do we have anything due on Thursday?
I'd like to look at the memo, pre-test, and homework.
Okay.
Yeah, that'd be great. Oh, sorry, say that again.
The exponential sum of 100, is it just what percentage of 100 over 1 plus I is the
That's what was I was trying to type it in, but you just and then you just do, yeah, and then you just put in pictures on the side.
Okay.
Oh, no, you said we could share some more food then.
Did you get it done? Yeah?
Thank you. I would not have been able to.
I couldn't find the format, so I had to make the scratch last time. Yeah.
Oh, well, now I feel bad just taking it out.
No, it wasn't that hard.